In this video, I'm going to show you the UK stocks that I bought this week, as well as the top riser, the top faller, as well as the share tip of the week. And if you enjoy the series, please drop me one of these to support the channel. Before you ask, I was in fact mugged for my hair. I'm just kidding, I have a family member that has done my haircut and that's how I've had it during the lockdown period. Starting the three top topics of the week, we are with Greggs. Greggs have been a popular investment stock mainly because people are obsessed over vegan sausage rolls. Once more, I'm just kidding, but it has been a good value recovery play that investors have latched onto as it does show signs of promise and is a national well-known brand. However, this week they had announced that they are going to be making 820 job cuts, and this is because if they do not make these changes, that it's very unlikely that they will be profitable. Just to give you a comparison, they in 2019 December layoff, they had approximately 24,000 employees, so it's not a big job cut yet, but it's still a fairly substantial amount of the employee count. But what it does suggest is that should the pandemic worsen, then perhaps Greggs may be struggling a lot more. WHMS are now reporting a pre-tax loss of £226 million, whereas this time last year they in fact had a profit of £135 million. This is because SMWH have a high reliance on travel. They have a majority of their stores in travel hotspots. Examples of this could be airports, it could be train stations, perhaps service stations, but they're even located in hospitals. What has really kept them up so far is their high street stores, which aren't actually their plan for growth. But what they do feel is that the company is resilient and agile, and that they are in a strong position to navigate this current climate. And that's because in the US, it's very likely that domestic flights will likely resume to near enough where they were before. And that's because there will likely be travel restrictions to other countries, but at least with the US, there's a lot more travel. And WHMS has a lot of exposure to the US. So, in turn, if they start having higher amounts of domestic travel, then this company can once again benefit and profit. As the second national lockdown was announced approximately 2 weeks ago, I had decided to create a Discord server, and this is so that we could all interact as a community despite all being isolated, perhaps on our own in this national lockdown. And this Discord server is basically an online chat forum which is a little bit more exclusive and a little bit more private than the typical web pages you see online. I made it in hopes that we could all connect together as a community and talk about the stocks that we're interested in, or just perhaps general finance. And that's despite being restricted on how social we may be in public. It's completely free, and in my own personal opinion, it provides a breath of fresh air compared to the boards on the London South East or even UK ADVFN. So if you'd like to join, I'm going to leave a link at the top of the description down below, and it is free, so feel free to join. And I will be active in the server from 2 PM till 4 PM today. For the last item of news, Tesco takes this spot for apologising to their customers. And you may think, what has this got to do with anything? It's not a simple, oh no, I'm sorry. Basically, their online and app services were down, and this is for online shopping bookings. Whilst they still likely have the capacity to manage this and have a majority of their bookings actually filled, what is interesting is that their online services itself had ceased to work. This has meant that people had experienced delays, but that's not the important bit. What I'm seeing is that many more people are feeling comfortable with online shopping, and therefore it seems more likely that an online trend is going to stay, and therefore I feel that there's going to be a larger benefit to these online only stocks, opposing to that of the high street retailers. Sorry, I forgot my bling. It does give that hint that the pandemic may be near over with this vaccine news, but it doesn't seem like online shopping is going away anytime soon. Which I feel transitions to the next segment of the video very smoothly. According to Google Finance, the FTSE 100 is up by 7.03%, the FTSE 250 is up by 7.6%, and the S&P 500 is up by 0.06%. I have a feeling as they were in the data somewhere. Regardless, I don't want to brag or anything, but my portfolio is down by a whopping 3.2%, which means I've actually underperformed the markets by over 10% in just 1 week. That's actually incredibly terrible. And I'm not worried in the slightest. Despite this quite frankly shameful display, I'm not concerned, and that's because I feel it accurately represents my sentiment towards the market. A lot of the stocks I would see or I would consider to be low quality, perhaps they've got bad balance sheets, little room for growth, and are just mature businesses that are just chugging along, such as the majority of the FTSE 100. I feel that my stocks haven't done that, and in fact a lot of them have actually declined in share price. And this is because it seems like people had been transferring their wealth out of these more resilient, perhaps technology stocks, selling out of these and then buying into these value recovery plays, which I understand if they think this trend is going to continue, but I feel it's like a big jump of FOMO and everyone seems to just be jumping in and hoping for the best. I feel that in regards to this, perhaps an opposite trend should be achieved, and that's because I want to talk about the vaccine just quickly. I cannot comprehend why an announcement made by the creators of Viagra, named Pfizer, or even BioNTech, have said that they have got a vaccine that is 90% effective of a sample size of 43,000, and yet the markets have rocketed. That seems a bit ridiculous to me. I very much understand that the markets are forward thinking, and so they are hoping that this is a positive step in the right direction in towards combating the pandemic, and therefore things are looking more hopeful. And very much so, the UK markets were heavily priced down, and they still are. You've got a combination of the Brexit vote, you've even got the pandemic ongoing, and that's why it does feel that that has been alleviated somewhat. But there's a lot of these low quality stocks that have risen in value. But there are a few big red flags in my head in mind of the pandemic and this vaccine. It seems really odd that the markets can just jump up like this because of a rumour of a vaccine. Obviously this is going to be reliable information, right? But at the same time, what do we know about the long-term health impacts of this? It could be 90% effective, but over the longer term, we may see some serious health impacts. How can we truly know that despite all of their testing, perhaps being FDA approved, that this is still safe for people? How can you convince people to take this vaccine when a lot of people are currently anti-vax? There's that whole argument, I'm not even going into it. And surely if we are pushing very fast with a lot of money, some things are going to be overlooked. Furthermore, it seems that the markets have simply assumed that everyone just have immediate access to the vaccine. But then there's a question of how are they going to be able to distribute it, and who would they choose? They've stated that in this year, that they'd be able to get 50 million doses of this vaccine. Well, we're quite a small proportion of the overall population of the world, so how much does that mean we'll have access to? So I really feel that the markets have kind of overvalued this statement. No doubt, I'm fairly certain that in the medium term we will no longer be worrying about the pandemic as much as we definitely are now. And so I do think there is a chance for recovery, but I do not think it will be that quick. And these businesses will likely be striving in that medium term. But obviously during this time period in which we haven't got a vaccine, we don't even know if it's that impactful, only that there's a sample size of 43,000 and they've stated it's 90% effective. We still do not know the impacts it could bring. We don't know if this is a fast mutating virus, which could mean that potentially these vaccines are rendered immune or rendered useless. And there's a very high probability that in the next year, businesses will struggle and some may go bankrupt. Ultimately, however, there's little logic in the markets, and I'm kind of arguing against a thing that's never logical. I can't just argue this and then suddenly the guys upstairs or the market makers are just going to go, you know what, actually that Osborne Foreman guy, he's quite right. You know what, yeah, let's have the markets drop by 5%. I think he's bang, because that's never going to happen. But I want to argue my logic so that you may get an understanding of my movements in the market. And if I were in this situation and I had some of these, well, lower quality stocks, I'm going to say a few examples. Obviously, you know I don't like Shell on this channel, but that's rallied quite a considerable amount. I would likely be considering to take profits from this stock, many large cap UK stocks that really aren't doing much, that you bought perhaps at a very low price, sell, get some value out of that, and then transfer into these more reliable technology stocks could be an example of it. And I think that would be a fantastic way to secure profits, perhaps even cut losses, and then move that into more reliable, resilient stocks that you know will continue to do well, even if the pandemic recovers or even if it doesn't. After all, does it really matter if you get a 100% gain or a consistent return on your portfolio over the next few years? And I think that you could use that money that you've taken from these equities to buy, or in my opinion, some of the winners that will benefit over the medium to longer term, and that way you're not stuck with these losers that will likely be downtrending for the next 10 years. But then what do I know? After all, this week I've massively underperformed the market. Furthermore, I'm now trailing the FTSE 250. 2 months ago I was beating the S&P 500, my eyes were set on the Nasdaq. But now even I'm very, very close to being overtaken by the FTSE 100, which is the world's worst performing index. I am currently only at around a 13% return, and this will not be completely accurate, but it will be accurate to a percentage figure, but not any decimal points after. Furthermore, the FTSE 100 in that time span has generated around 10%. I was very much ahead of the FTSE 250, and they're sitting at around 23% now. So as you can see, I'm trailing the UK markets. So what do I really know about this? And what validity can I bring to that? And I don't think it's worthwhile me arguing this, but I'm hoping that over the medium to longer term, that eventually my portfolio will come back in line. Hopefully we will continually beat the markets, and that's all I would like to achieve. Going on to this, my only performer in the green, so my top performer, there was one stock that was actually up this week, and it was up by 3.33%, and that was Ashted Group. And I've spoken about this a lot on the channel. I think it's been a top performer for probably the last few weeks in a row, and that's because they are very heavily tied to the UK economy, which is my one-liner that I like to mention every single video. But this is a stock that's in the FTSE 100. It's probably more or less seen as a value recovery play. And to be honest, in my portfolio, it likely has the lowest PE ratio, and it's in an industrial sector that will definitely benefit from a vaccine to the pandemic. So I completely understand why it has been slightly priced up. On the completely opposite side of the spectrum, however, we have the worst performer, and in fact, of the FTSE 350, right? This was the second biggest faller this week, and that's Games Workshop. They'd actually dropped by something like 14%, more specifically 14.09%. And actually, I very much understand this sentiment. This stock had dropped because they likely would have continued to benefit from a pandemic. So if we assume that there was further, maybe more extended lockdown periods, then some people may likely have more time for their hobbies. I know at least in this time period, I'm furloughed. Other than YouTube, there's not really much for me to do. If I had a hobby like Warhammer, then I would be investing a lot more time into it. Therefore, I do feel that this could be a significant impact to their overall revenue. But I'm not concerned about this because I'm not invested for the next 6 months. I'm invested for the next 5 to maybe 25 plus years. And so it doesn't matter how fast their revenue growth is, as long as they are steadily, consistently growing and making strides in the correct direction. And I feel at a price to earnings ratio of 45 times, I think that adequately reflects the amount of growth that you may be seeing. It's not going to be a top high performer that's managing to get triple digit growth each time, and it's got some ridiculous value of something in the US markets of over a 100 price to earnings ratio. But it's at least there. It's got a fair value, and to be honest, I may likely buy more into this because I believe over that future period, this could be a higher value opportunity in the longer term. And if you sign up to Trading 212 using my link in the description down below, you can get free share worth up to £100 when you deposit just £1. This week, I had bought a few more shares of Softcat, and this will likely be no surprise as I mention this every single week. However, I'd done some research into the industry a little bit further, and what I had noticed is in the last month period, Kainos, Computer Center, which are all in the same industry, had all in fact dropped by a similar amount, which kind of gives me the hint that while Softcat is massively underperforming at the moment, they aren't doing that bad when compared to the sector because all of them have underperformed by around 8 to 9% each. So this gives me a little bit more hopes. The industry isn't got that great of a sentiment. Neither has Softcat after that, well, quite gloomy forecast or trading forecast. So what I've been doing is I've just been adding a little bit more equity into it. Currently, my position size is 9.7% of the portfolio. I'm trying to move that to 15%. I think that's a fair amount, and seeing as it's one of my only stocks in the red, I figure that's a good time to continue doing that. Obviously, I had a comment before by I think the person that has the most hearts on comments before mentioned that I'd fallen out of love for Halma. And this is fairly true. They have got an earnings update, I believe, on the 19th. I do not, that's off the top of my head. And this is something I would like to continue developing once I've kind of pushed Softcat back into that area where I want it. Then it's a question of getting Halma, London Stock Exchange, and perhaps topping up Games Workshop here and there, because I do want that position to have more equity in it, but obviously you've got to find a time and a place, and because it takes up such a high amount of my weekly deposit, I've got to be very careful with it. Anyway, with Softcat, I feel that the pandemic is likely going to be making permanent changes to the business economic climate, and therefore I very much feel that if businesses do not decide to upgrade their infrastructure to a more technology related means, then they're likely going to fall behind should the worst happen. And say we had another pandemic, sure, we would be better prepared for it, but that would still definitely put a lot of businesses in quite a struggle. So therefore, I definitely feel that would be a good investment for them. And therefore, over this next longer term trend, I definitely feel that Softcat will benefit from this. Once they continue developing their product line, have more of a range of businesses they can target and more of a package they can include all in one, then I very much believe they will be a winner. But for now, sentiment will remain low, and it will likely remain low for the next trading update. At the moment, my portfolio may look boring. This is because I only hold 6 stocks, and I've had a lot of questions going, well, are you planning on adding more? And currently I'm not. There are 2 stocks on my watch list, and needless to say, they're a little bit hidden for now. I've not made any substantial top-ups in about 2 months, and this is because I'm desperately trying to build up cash. You may think, what, do you think there's a big crash on the way? Well, no, this is actually for personal emergency purposes. I think the hospitality sector is in a severely terrible position right now, and I very much feel that now is the time to be building this emergency fund because it had been lacking. I need to get this up on the off chance that I get made redundant. I think it's unlikely, but the sector as a whole isn't looking too promising. So if I have this money behind me, I can then look towards or have less worries when perhaps relocating. If you'd like to know more about my income, more specifically my YouTube income stream and also all of my actual earnings, then I'm going to be making a video at the start of December. So if you're interested in that, don't forget to subscribe so you don't miss out. So the share tip of the week may be controversial, and that's because it's a stock I have mentioned a lot, but it is a stock I really feel will be a top performer. And in fact, I believe they will very much take advantage of this time period and be complete and utter winners. That's because e-commerce in a time such as the pandemic, I believe to be a very strong winner. A lot of these high street stores are shut. It's very much assumed that they will be reopening, especially in the UK, in that early December period. But how can we be sure? After all, a month lockdown, it might be a circuit breaker, but surely that means the pandemic will likely come back round at a faster rate than it did since the last lockdown, which means I suspect at least in the first half of 2021 there may be an additional lockdown. Another lockdown means these high street stores aren't getting much sales, and therefore an e-commerce only business that has got higher margins than that of the retail stores, as they're not paying as much rent for the commercial space. Obviously they have warehouses, but regardless, then they will be winners. Even if they're not just winners right now, they will be over the longer term. Obviously there would be a few red flags, and that's because people, if they're not leaving the house as much, why would they be purchasing goods to impress others? But then that brings social media to it, and this company obviously is Boohoo. Boohoo have many different brands and subsidiaries, and on social media, whilst I suspect I have got a bigger range, or I'm in that target audience, so I will be seeing a lot more content by them, but Pretty Little Thing, I've seen countless memes for. I've not been tagged in them, I don't have friends, but the people that I've got added on my Facebook, they seem to be sharing these memes a lot, and it's kind of like, yes, Pretty Little Thing, yes, Boohoo. And it really shows that even in this period, if they're not making as much sales, what they will be making is more brand awareness, and that's a winner to me. Obviously, this is a high risk with a very high potential growth stock, but we cannot confirm this, as at the moment they are going to be lacking an auditor, and if they don't find an auditor, things could look very gloomy. But I do feel that for the moment, that this could be a great opportunity, because at the moment, whilst sure, you would be buying a lower quality stock than it could be, and at a cheaper valuation. But in a year's time, they've had so many governance changes, and they've had a push from their independent review by Ms. Alison Levitt, and therefore I feel that they're going to be making strides in not only improving their governance, making sure they're regulating their practices more thoroughly, but also as a business, during this time period they're likely going to benefit a lot. And this time period is crucial. You'll be buying a worse company now that's struggling, but in a year's time they could be 3 times the quality, and you got them at a fantastic bargain. That's why I've mentioned them, and I know that this may be controversial, as typically with share tips of the week, I like to talk about stocks that I don't own. If this is an issue, I very much will like to hear your opinions in the comment section down below. If you don't want me to list any of the stocks I hold, that's fine, because obviously variation in content is important, especially when I only have 6 holdings. I must disclaim that yes, I still own 2,500 shares of Boohoo at an average price of 246 pence, of 248 pence and 36, and so it is a big holding in the portfolio, taking up over 51%, but I'm very bullish on the company. They're in a high growth industry, and I very much think they're going to succeed over the next 5 to 10 years, and even over that longer term, they will be a beast. If you're interested in how many shares of popular UK stocks such as GSK, BP, that you would need in order to get £100 a month in passive dividend income, then click the card at the top right of the video. This is the Osborne Foreman Show. Thank you for watching. Stay safe.